Welcome, everyone, to another exciting episode of CRE Exchange. I'm Cole Perry, your host and Associate Director of Research at Altus Group. I'm joined by Omar Eltarai, our Senior Director of Research. Together, we'll share the latest news and trends in the U.S. commercial real estate market. Omar, great to be with you. What do we have on our agenda today?
Yeah, so we got a lot of macro news. We're going to first cover the Fed Beige Book, and then we'll dive into the plenty of labor data that we got over the last week, including Jolts, ADP, and the employment situation reports. And then we'll turn attention to some property sectors, specifically focusing on unanchored strip centers this week.
Excellent. How about you kick us off with Beige Book?
Awesome. So the Federal Reserve released the August 2025 Beige Book on September 3rd. In terms of high-level takeaways from the August report, I would say stagnant growth, consumer pressure, ongoing pricing inflation from tariffs, and some signs of softening in the labor market, as well as just a persistent sense of economic uncertainty. Those themes were highlighted across the different districts and noted at the national level as well. But to dive into the report a bit deeper, most districts reported little to no change in economic activity, with really only four districts showing modest growth. The economy really appears kind of stuck in, a bit of a holding pattern. There were kind of widespread reports of flat to declining consumer spending, as the business contacts in the report noted that wages are failing to keep pace with rising prices, and households are increasingly price sensitive and trading down to lower cost alternatives. A contributing factor to the price pressures and the higher prices that the consumers are facing is the ongoing kind of trade uncertainty and tariffs. There was a near universal mention from the different districts of tariff-related cost increases, and those increases affecting input prices across various sectors of the economy, which many firms also noted as struggles with ultimately the ability to pass those costs on to their customers. Employment levels were reported to be largely flat, with increased hesitancy to hire due to uncertainty, with 11 of the 12 districts reporting little to no net change in employment. And finally, uncertainty continues to be a dominating theme, as you could probably already tell by how many times I've said uncertainty, but it's broad-based and across the economy and is driven by trade policies, immigration policy changes, and ultimately this is coming through in constrained business decision-making across the regions. If that's setting the context kind of at the high level and the sentiment across different sectors and across the nation, if we look into the report and try to parse out CRE specific themes, I would call out the commercial real estate showed kind of varied results across the districts, but remained generally subdued, with most of the districts reporting flat to slightly declining levels of activity and continued financing challenges. Multiple districts cited high interest rates, elevated financing costs, and economic uncertainty as constraining factors for new development, as well as transaction activity. The commercial real estate sector also appears really to be experiencing this bifurcated market that we've been living in for at least the last 18, probably 24 months, where there are some clear winners and some clear, I would say, losers or those that are facing much bigger challenges. If you look across the report, I would say the winners are data centers, high quality office space, and industrial space, and then pretty much everything else was not showing positive signs or was showing pretty muted signs since the last Beige Book. Now, if we look and dive into those specific call outs of the different property sectors and the commentary around those, on one end of the spectrum, you have the office market. So the Richmond Fed noted that office space is in modern turmoil as companies navigate return to office mandates, and there are reports of outdated office buildings being torn down. New York, on the other end, has seen and reported a surge in leasing activity with record high rents in Class A Midtown office space, while Atlanta also kind of echoed that positivity and similarly reported an uptick in demand for highly amenitized office space, which is helping to stabilize the Class A property market. But kind of somewhere in the middle, the Boston Fed reported that office leasing is up slightly, but improvements were minimal, and they weren't seeing anything quite like the New York style resurgence. Now, somewhere in the middle of the property spectrum of, the spectrum of health or how different spectrums are performing was retail. So it got two call outs. The first being from the Atlanta Fed, which noted that conditions weakened as small businesses requested rent relief due to inflationary pressures, while the St. Louis Fed noted that retail demand remained strong, according to at least one Tennessee development group that they spoke to. Now, getting warmer on that property spectrum was industrial. So the New York Fed mentioned that there's strong industrial demand in northern New Jersey for warehouse and distribution centers, while the Chicago Fed mentioned strong demand for warehouse space. And finally, the Dallas Fed also characterized the industrial activity as, quote, solid. And I think at the far end of the spectrum and somewhat new addition to property types covered or at least picked up in the Beige Book is data centers. This was really a clear bright spot amongst property types, with the Philly Fed, Cleveland Fed, and Chicago Fed all noting that data center construction is really a rare strength within the commercial real estate landscape and within their regions, while the Atlanta and Kansas City Fed reported that data centers are ultimately driving up increased energy demand. So data centers, this is separate from the Beige Book. Data centers are increasingly an area of interest for the CRE industry. So this is an area that we're going to likely dive into more on a future podcast. The Beige Book does a good job of providing some qualitative color or a pulse check on the economy as a whole. But last week was really chock full of labor market data, with the Jolts report, ADP, and employment situation coming out. Cole, I know that you were paying attention to a lot of these labor releases. What were some of the nuggets that you pulled from?
Yeah, so I made you go through the ANIC data. So we're going to go through some of the hard data. Got a lot of it last week. So we'll start with the Jolts release. This is the Bureau of Labor Statistics Job Openings and Labor Turnover Survey. It came out on September 3rd. Showed that job openings slipped to 7.2 million. That's down from 7.4 in June. It was actually the lowest in nearly a year. Hiring was fairly steady at 5.3 million. Separations were fairly steady. Quits at 3.2 million and layoffs at 1.8. But I think the important figure is the rates here. So the hirings rate was actually up slightly to 3.3%. Layoffs ticked up as well to 1.1%. Quits were down to 2%, and the openings rate fell as well to 4.3. But all of that being said, there was one particular figure that I think has been really focused on over the last week or so, and that is that the ratio of job openings to unemployed workers actually dipped to under 1-to-1, and that was for the first time since 2021. So this is a really big signal here. But by September 3rd, we had already had some signals that clearly pointed to the labor market losing some steam. The Jolts data alone implied that employers are pretty cautious about adding staff. Turnover or job switching is pretty weak. We haven't seen mass layoffs surge yet, but the fact that there is limited turnover is a big damper on wage growth and household spending, in addition to just demand for space. Obvious implications for CRE like demand for office, retail, other consumer-facing property sectors, but I also think some implications for the broader economy, which I know we'll get to in a bit. The next release was from ADP, and this is ADP and the Stanford National Employment Group put out this report. This is an early read on labor market momentum. So this is for August, and it's a private company that puts out a report that comes out in advance of the BLS report. And they showed that in August, private sector employers added 54,000 jobs. That was down sharply from the 106,000, or rather a revised 106,000 that they say were added in July. So clear deceleration in hiring. And in their release, growth mainly came from leisure and hospitality, as well as construction. But manufacturing, education, and health services registered declines. Despite weaker hiring, they did say the jobs stayers actually saw a 4.4% increase in median annual pay, which might go against actually some of the stuff that was mentioned in the Beige Book. But some resilience in incomes, even as employers are pulling back on headcount. So I think a lot of folks, and particularly the Fed, pay attention to this as a signal for what might happen with Fed policy. August had a pretty weak and weaker than expected job gain, and definitely reinforced the position that cuts could be on the table. But again, ADP is a private, very high frequency snapshot of employment and pay. So it helps shape expectations for what we might see. But people really pay attention to the government report, which I know you took a look at this week. So how about you run us through some of the employment numbers?
Yeah, so the employment situation report was released on September 5th by the BLS and covered the month of August. I would say the report was market moving, and it really drove home and increased the conviction behind the expectation for a cut at the Fed's next interest rate decision. And so the employment report really, I would say, showed some rather meaningful signs of labor softening. First, we'll run through kind of the headline data, so non-farm payroll employment rose by only 22,000 in August. This is a continuation of the rather flat trend observed since April. June's figure was revised down to a negative 13,000, while July was revised up to 79,000 for a net downward revision of 21,000. And the unemployment rate ticked up slightly to 4.3%. That's up 10 basis points from July's 4.2, which means that 7.4 million people are unemployed. Both figures really have been relatively flat over the year. And in terms of labor force participation, the participation rate was unchanged at 62.3% in August, while the employment to population ratio held at 59.6%. Both the participation and the employment to population ratio are down about 40 basis points from a year ago. Now, the sectors that saw the, I'd say, strongest job gains or job numbers were healthcare, which continued to be a kind of a bright spot amongst all the different employing sectors, and added 31,000 jobs in August, though this is below the 12-month average of 42,000 jobs. Social assistance also was, I would say, in that kind of stronger performing sector, and it added 16,000 jobs, but mostly in the individual and family services. While the sectors that saw job losses included the federal government, which saw declines of 15,000 jobs in August, bringing the total loss to just shy of 100,000 or 97,000 jobs since January. Wholesale trade also saw meaningful losses, as well as manufacturing. On the wage front, average hourly earnings rose by about 30 basis points or 0.3% month on month, and are up about 3.7% year on year. Turning attention to unemployment, long-term unemployment remains elevated at 1.9 million people, which that accounts for 25.7% of the total unemployed population. That's up by 385,000 over the past year. New entrants, so these are folks that are looking for their first job but are unable to find a job. In August, that number fell sharply by 199,000. This partially reverses last month's increase. And then finally, within the unemployment data are people who are not in the labor force but want a job. That stands at 64. Okay. And finally, within the unemployment data are those people who are not in the labor force but want a job. And that number stands at 6.4 million. That's up 722,000 over the year. And this really indicates that there's continued slack in the broader labor market. But if we just threw a lot of numbers at you, overall, the employment situation report really paints a picture of a still stable but cooling labor market. And it's characterized by sluggish payroll growth, rising, although it's only slightly rising, unemployment and long-term joblessness, which is ultimately showing signs of slowing demand for labor. These trends, is I started this comment or run through by saying this was market moving. This report really drove home the fact that the market is expecting the Fed to lower rates in their September meeting. And you could see this play out in the futures market, where before the report, it was about 90% probability that the Fed would have a 25 basis point cut. And now it's shifted to 90% believe that there'll be a 25 basis point cut, 10% believe that there'll be a 50 basis point cut, but pretty much the markets are certain that there will be some cut at the Fed's September meeting. Let's get out of macro. Let's dive into some CRE. Cole, I know you recently dove into some unanchored strip center data. What did you find there?
Yeah, I think occasionally on this show, we'll do a deep dive into a particular kind of property sector, some of the research that we're working on. So this kind of came out of a conversation that I had with ICSC for an upcoming piece on strip retail and particularly unanchored strip centers in comparison to grocery anchored, which has been the investor darling over the last couple of years. So asking the question, are these unanchored strip centers with say 4+ national tenants, are they the new quote grocery anchored in the post-pandemic consumer spending boom? So I did a little analysis and I don't want it to go to waste. So I want to share with some listeners here. I found some interesting stuff. There's some tenant data within Reonomy that I was able to use to classify a few different kinds of retail properties. So centers with a grocer, centers without a grocer, the grocery anchors themselves, and all other anchors. In the event these were on different parcels, so I pulled some transaction data from these and found some really interesting things. Not surprisingly, historically, the typical center with a grocer priced on par or at a slight discount on a per square foot basis to all other kind of strip retail centers. But that did flip during the pandemic. Centers with a grocer actually now trade or have traded over the last few quarters typically at about a 10% premium to strips without a grocer. But there was something really interesting in here. There is actually a huge discount for the grocery anchors themselves compared to all other anchor stores. And I think a couple of reasons for this. Grocery is a really high volume but low margin business. Anchors have really long lease terms, smaller rent bumps. These grocery stores have huge CapEx requirements and ultimately limited exit options. But a reminder, this data is completed transactions. Sometimes you sell because you want to realize your return or you have to sell. But conversely, sometimes you don't want to sell sometimes you do not want to sell because you cannot sell or because you don't want to. And so we're only working with about 15 to 20 grocery sales per quarter. So interesting data. Now, the question asked in some of this research was, are unanchored centers the new grocery anchored centers? And I think that might be the question wrongly asked because they can be better than other kinds of retail, but still worse in comparison to grocery. They clearly have some advantages, but if you were to just compare unanchored centers to grocery anchored centers with some of our cash flow data, still grocery anchored centers look much better by comparison. They have higher weighted average lease terms, and relatedly, a positive trajectory for the amount of space expiring within 3 years. Grocery anchored centers have higher occupancy, and they actually now exceed Q4 2019 levels of occupancy and have so since early 2024. Really can't get much better there, seeing that it's in the high 90s. Market to contract rent spreads are more attractive for grocery anchored centers than for unanchored, about 8% versus 4%, though both have been accelerating for the entirety of the post-pandemic period. But I think ultimately what I found looking at this, and I may dig in a little bit more in some future work, but unanchored centers are pricing very differently now than they used to. And I think this is because they are becoming perceived as fairly safe assets, relatively speaking, to some other parts of the retail landscape, even if they aren't relative to grocery. But definitely had some interesting nuggets. Hopefully when that link is out, we can share it with folks for the ICSC piece, or if I put something together on my own, we'll be happy to follow up with folks. But definitely some interesting stuff in there I wanted to share with our listeners. But Omar, I think we've got a busy couple of weeks coming up. How about you tell folks what we're up to?
Yeah. So we'll be on the road by the time of this episode release. Hope we will have seen some of the listeners at some conferences. I'll be headed to Toronto for NAIOP's CRE Converge, and Cole's on the road to CREI Summit in Palm Springs. If we weren't able to connect at the conference and we missed you, reach out. I would love to connect. But then also we'll be going to Blueprint in Las Vegas next week by the time you're hearing this. So we hope to see you there. If you want to meet up, feel free to shoot us a note. And if you want to connect but not in person, feel free to shoot us a note. But in terms of econ data and data releases upcoming, Cole, what should the listeners have on their radar?
Yeah, it's also going to be a busy few weeks here for some data releases. And so starting with Tuesday, September 16th, we're going to get retail sales data in the NAHB Housing Market Index, both of which we've covered on the show before. And on Wednesday, we have building permits and housing starts as part of the new residential construction report from the census, the Atlanta Fed's GDP Now forecast, in addition to the FOMC interest rate decision, which we talked a little about earlier in the show. But lots of good stuff to keep an eye out on. Omar, I think that is all the time we have today. But before we sign off, I just want to encourage folks as usual. If you like the show, we'd love if you could rate it. Please give us 5 stars on Apple or Spotify. Leave us comments there as well. We do read them. Feel free to send us an email at altusresearch@altusgroup.com. We'd love to know what topics you'd covered on the program. But in the meantime, it's been a pleasure. I look forward to speaking with you on another episode of CRE Exchange. Have a good one.